Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group, and today we're going to be going over how certain assets are taxed when you inherit them. So we'll be talking about if you inherit a house, if you inherit stocks, retirement accounts, annuities, life insurance, if you inherit assets that come from a trust. All these different types of assets have different tax ramifications when you inherit them. Also, there are estate tax limits that you have to be aware of. And then Biden might be making some changes to these inheritance rules that you should be aware of for coming months and coming years. The most common asset that people inherit is a house. So if your parents had a house, they pass away, and then you and your siblings then inherit that house and then plan to sell it. The question becomes, do you have to pay tax when you go to sell that house? In many cases, the answer is no, because people receive what's called a step up in cost basis. And you'll hear that term referenced a lot during this video. And what that means is, for non-retirement assets like a house, if your parents, let's say, bought that house many, many years ago for $30,000, and then when they passed away, the house was worth, let's say, $300,000. You, as the beneficiary of the estate, receive what's called a step up in cost basis, meaning your cost basis steps up from their $30,000 up to the $300,000, which is what the house was worth when they passed away. So if you sell that house for $300,000, there is no tax event. However, it's not uncommon also for, if that estate has to go through the probate process, that it could take 6, 9, 12 months before you actually have the house to sell it. That if the house appreciates between the time they passed away and the time you sell it, beneficiaries do have to pay tax on that additional appreciation. So in that example, you inherit the house, it's worth $300,000 when your parents pass away, but then you sell it for $350,000. You don't have to pay tax on the $300,000, but you do have to pay tax on the $50,000 that appreciated between the time they passed away and the time you sold it. The same concept of step up in basis also applies to non-retirement investment accounts. So if you receive stock, you receive mutual funds that are in like some type of brokerage account that was owned by, again, let's say your parents. If they bought Amazon forever ago for like $10 and now it's worth $3,000 a share on the day they pass away, your cost basis steps up to whatever the value is of those securities on the date they pass. So you sell them and there's that step up in basis. You don't have to pay tax when you sell those securities. Another common asset to inherit is a retirement account, like IRAs, 401ks, 403bs, and these are taxed much differently than the assets we've already talked about. So first, there's pre-tax retirement accounts, which pre-tax retirement accounts are traditional IRAs, 401ks, 403bs with really pre-tax sources. And the way those pre-tax accounts work is when you inherit them, you can roll them over to your own inherited IRA, but as you take distributions from them, you have to pay ordinary income tax on those disbursements when you take them. There is no 10% penalty regardless of what your age is, similar to if it was a retirement account in your name and you took distributions prior to 59 and a half. Usually there's that additional 10% penalty. Because these are considered death distributions, you don't have to pay that early withdrawal penalty, but the federal income tax, and depending on the state you live in, state income tax could be waiting for you on those pre-tax retirement accounts. Now for Roth accounts, if you inherit, Roth 401k or Roth IRAs, you as a beneficiary do not have to pay tax on any of that account value, because Roth's accumulated or distributed tax-free as long as that Roth account was in existence for at least 5 years. There is an important difference though, as far as what type of beneficiary you are to that account, what your options are when it comes to retirement accounts. So spouses and non-spouse beneficiaries have different distribution options that are available to them. Now I'm just gonna give you a 30,000 foot view, but I'm gonna put links in the description of this video so you can get more details on this, because it goes pretty in depth. But just kind of know, if you are a spousal beneficiary, you have a few options. So you can take the cash distribution directly from the account and pay the taxes. You can open up an inherited IRA and roll that into an inherited IRA account, or you can roll it over to your own personal IRA account and then continue to accumulate there. Now there's pros and cons depending on your age. whether you need the money, things like that, which you'll find in the other videos. Now, if you are a non-spouse beneficiary, let's say it's your parents that you inherited this account from, the only options you have is to take cash distribution from the account, or you have to roll it over to an inherited IRA. And under the new Secure Act distribution rules that were recently put into place, it used to be if someone passed away prior to 2020, you could roll it over to your inherited IRA and take just small RMDs, small distributions over your lifetime and continue to accumulate the account. But then they changed the rules. For anyone that passed away after 2019, if you are a non-spouse beneficiary, you have to usually deplete that full account balance within a 10-year period unless certain exceptions apply. And again, we'll put the video in the description below. The next asset is life insurance, and life insurance is really easy because life insurance is typically received tax-free. It doesn't go through the probate process. It just goes directly to the beneficiaries. Annuities are the next asset class we'll talk about. So there's two different types of annuities. There's qualified annuities, and then there's non-qualified annuities. And you can usually tell what type of annuity is by just looking at the statement. So a qualified annuity is kind of that pre-tax retirement account, like an IRA or something like that, that's actually just an annuity vehicle. So that will kind of follow the IRA rules. But for non-qualified annuities, so you can have just really after-tax money put into an annuity, they have their own rules. Because like we talked about, investment accounts could potentially receive a step-up in basis. Non-qualified annuities do not receive a step-up, which means if you inherit a non-qualified annuity from your parents and they put $50,000 in it, now it's worth $150,000, normally you would assume you would get that step-up in basis when they pass. That does not apply to non-qualified annuities. When you inherit it, you have the same $50,000 cost basis that your parents had, and then you have to pay tax on the gain within that contract. It's becoming more common that individuals are being more proactive with their estate and actually setting up trusts. And there's two types of trusts out there. There's revocable, or called living trusts, and then there's irrevocable trusts. And if you're a beneficiary of one of these trusts, you may or may not receive a step up in basis depending on the language in the trust document. Now, for revocable living trusts, typically those get a step up in basis because they technically still kind of own the asset. They're just trying to avoid the probate process. But for irrevocable trusts, they've essentially given that house, given that investment account to that irrevocable trust. Depending on the language in the trust document, you may or may not receive a step up in basis as a beneficiary. And I also encourage anyone that has a trust, if you set up a trust a long time ago, it's a good idea to go back and review that language, because many years ago, the estate tax exemptions on trust. So if you had so much in assets in your estate when you passed away, sometimes you had to pay big Fed tax. But what they did is over the years, they increased those limits substantially. So not many people pay estate tax anymore, but they originally designed those trusts to almost get it out of your estate, because when the limits were lower, but you don't get a step up in basis if the assets do not go through your estate, which then your beneficiaries inherit it and have to pay all the tax. But now that the limits have gone up by so much and you have that big exemption, you almost want the assets to be in your estate so the beneficiaries then get the step up in basis and don't have to pay tax on it. We've seen cases where we're talking hundreds of thousands of dollars in taxes just because someone forgot to update the trust document many years ago. So we always say go back and review it. While we're talking about these federal estate tax limits, let's go over the amounts. So what these amounts are is if you pass away and all these assets are going through your estate and you have amounts over a certain threshold, you have to pay tax, or your estate has to pay tax on those amounts before they go to the beneficiaries. Now, with all the rules changes that have happened in recent years, as of 2021, and I'm filming this in June, the federal estate tax exemption is about $11.7 million. So an individual would have to pass away with more than $11.7 million in their estate before they would have to pay any federal estate tax. So again, limits are pretty high. But also you have to check your state tax limits, because states could have different limits that vary from the federal limit. So you got to almost keep an eye on both, because while you might not have a federal tax liability, you might have a state tax liability depending on where the limits are for the state that you essentially reside in. Another quick note that $11.7 million is for an individual. If you're married, you double that. So it's actually $23.4 million for a joint exemption. The Biden administration has already communicated that it may make changes to how the estate taxation rules work. So some of the conversations have been lowering that exemption from that 11.7 down to a lower amount. And the other thing that's really on the table that I think is the biggest risk is they're talking about taking away the step up in basis. So whether they're going to take it away entirely or they're just going to set a threshold that say, hey, any assets that you inherit over, let's say $1 million, you don't receive a step up in basis over that threshold, which is going to be huge for a lot of beneficiaries, and it could change people's estate plan. So it's one of those, just stay tuned to the legislation, see what comes out, because it could cause people to have to go and revisit their estate plan overall. I hope this was helpful. Feel free to contact me if you have any questions at moneysmartboard.com. Thank you.